Welcome to the Daily Brief, where I'll go over the action in the market for Friday, January 27th, and then we'll see how things look for Monday, January 30th. We had another update on Friday. Not as strong as earlier in the week, but still, it was positive. It's helping the longer-term technical picture to improve. However, some of the warning signs that I talked about for Friday's video, they're still there. We're seeing a little bit of weakness start to develop. During the day, there was a sell-off going into the close, and some of our indicators picked that up, and they're starting to give us a little signal. The S&P is now dealing with 4,100, where if it can get above that and break above that from the October low, we would have a series of higher highs, and that could be very positive for the market. But on a short-term basis, we're looking a little overextended to the upside. The NASDAQ and the NASDAQ 100 had good days, and they were able to close above their 200-day moving averages. So let's go back and talk about what happened. Right at the open, we had a higher open. There wasn't a real gap from Thursday's close to Friday's open. Prices got all the way up to R1 immediately, and that was at 4,077. What's very common when we see some kind of a thrust or a gap, either up or down, we see a counter trend move in the short term, and that's what happened. Prices then retraced, and they ended up going down to the 4,050 level before bouncing from there. Prices were then able to climb back through R1. They got all the way up to R2 at 4,093. We went above that slightly. We just got a little bit underneath the 4,100 mark. Prices fell going into the close, and we ended up closing down below R1. We were up 0.66%. Volume was still above average. We're not seeing a huge expansion of volume as the market's going up because you have a lot of people that are really skeptical of this, and that's probably the reason why the market's going up. The technicals are still positive, but getting a little overextended, and I'll go through those. Inflation and interest rates are still the big focus. It's been the focus now for about a year, and it will continue to be the focus. And this is feeding into the earnings per share and valuation concerns. We also have those geopolitical concerns with the U.S. and Germany sending tanks to Ukraine. Haven't really seen much in the way of reaction from Russia yet, but that could happen. Earnings are coming out, and we're right in the middle of earnings season now, and so that's really having an impact on the market. And then the debt ceiling continues to go unsolved, so that's more of a political maneuver going back and forth. Here is the intraday chart where we had a higher open. We immediately went up to R1 and then came back down. We set this, well, not really a base, but we got down to about the 4,050 level and then spent the rest of the day going back up. We were able to get back up to R1. That acted as overhead resistance for a while, and then we broke up and got up to R2. And then here is some late day weakness that we saw. If you look at this chart going back to Wednesday's low at 39.50, and we pretty much have been climbing ever since then, and that's pretty healthy. A little bit of weakness right in here going into the close. We still have had a really good run this past week. What are some comments that we can make? The rally continued from Wednesday's low. There was probably a lot of short covering going on, mainly because you have folks that are just convinced that the market's going down, and it may do that. But at least in the past week, it's had a really strong week. Now people are going to sit back over the weekend, evaluate things, and then decide what they're going to do next. And with the market turning more positive, that could go over into Monday's session. There's also this FOMO, the fear of missing out, FOMO. People were convinced the market's going down. All of a sudden it's going up. They're going, oh my gosh, I better do something. I don't want to be left behind in this whole thing. And they get in, and sometimes that's more of a reaction rather than a proaction to what is happening. But we have to keep asking this question, can it continue? There are some really strong headwinds going against the market right now, and at some point they may come in and take over. But right now, as of Friday's close, we had a really positive week. Intel, KLA Corp, Chevron, Hasbro, they all came out with their earnings reports or guidance or some kind of news that was hitting the market. The market didn't really like those. So all of these stocks took a hit, but nonetheless, to see big players like this coming out with negative news and the market still going up, that shows some real resiliency to the market. The S&P is getting close to 4,100. Internal weakness may be developing, and I'll mainly go through and show you that in the charts. On a short-term basis, our stochastic, Stoch RSI, Williams percent R, the usual ones, they're extreme positive. Intermediate term, we have the Sean Trend Meter, CTM. The rate of change 20 also is looking a little topsy, as well as the CCI 14 and 20, and then the ultimate oscillator. That's one that I don't talk about all that much. It's starting to get extreme positive. Long term, we still have that moving average steady. With the 150-day moving average, we're looking a little extreme positive. The dollar was up, and interest rates were also up. Copper is still hanging on to its gains. I don't have any charts to show you these things. I just want to tell you what was happening. The inverted yield curves are still the same, the 10-year to the 5-year, the 10-year to the 2-year, and the 10-year to the 3-month, with the 10 to the 3-month being the most drastically inverted. It was the last one to go inverted, and now it's the most extreme. Sentiment is still positive. We have the same reading from Thursday to Friday, where we closed at 69. We're in that positive area. If we get a little higher than this, we will start to become extreme. I do have some economic reports to show you, but the list was pretty long, so I just decided to put it on the next slide. Our trend is still positive. It's still above that moving average, so it's getting a bit stronger, but we are below 20, so officially we are still in a trendless environment. Even with the run-up from Wednesday through Friday, the ADX is not really picking that up, at least yet. Our bias is positive, and our momentum is positive. Here are the economic reports that came out in Friday's session, and these were big. Personal income came in at up 0.2% as expected, a little bit lower from the 0.3% that we saw last time. Personal spending decreased. It was down 0.2%, more than the 0.1% that was expected, and it was down 0.1% last time. PCE prices, this is an inflation gauge here. They were up 0.1%. They expected it to be unchanged, and last time they were also up 0.1%. The core PCE was up 0.3% as expected, and last time it was up 0.2%. So we saw a little bit of a tick up in inflation, and the market could have latched onto this and just tanked over that, but they didn't. One thing that is a little concerning is the services inflation that's kind of internally reported in this economic report. It was up 0.5% on a month-over-month basis. The last time it was up 0.3%. So that's a little bit of a concern from an inflationary standpoint. Pending home sales were up 2.5%, much more than what they expected. They expected it to be down 1%, and last time they were down 2.6%. Consumer sentiment came out with the final reading. It was at 64.9. They expected it to come in at 64.6, which is what it came out with in the preliminary report. And the last time we got this, it was at 64.6. Here's a chart that I ran across somewhere. It might have been on Twitter or something that I'm reading through. This is put out by Piper Sandler, and this is their stance on things as of a couple days ago when I found this chart. We expect significant downside markets for the second half of 2023 as the employment backdrop deteriorates sharply. That's kind of the last thing that the markets are waiting for. The economy has been showing weakness and things are going down, but employment has been holding up. When employment finally starts to roll over, then people are going to be more willing to admit that we're in a recession, and we could see some damage in the markets, but it's usually coming to the end of a recessionary period. It said we're expecting a range-bound market with limited upside potential until employment breaks. They have their little checklist, potential list of bear market rally catalysts. Lower gasoline prices, that happened in June 2022, and the market went up. Softer inflation in October. That's when we hit the supposed low in the S&P, and the market went up. Now we're waiting for the employment data to become weaker. When that happens, they're assuming that the Fed will actually do a pivot, if they're hoping upon hope here, that there may be an end of the Russia-Ukraine war. Not so sure about the last one, but the other ones can fit more into an economic scenario. And here's a chart just showing how things have happened and how we've seen declines and advances as the market has chopped all around. If you are a long-term investor, 2022 was very frustrating for you. If you do multiple time frames, short, intermediate, and long-term, it's probably one of the best years you've ever had. And if you go long as well as short. Another chart that I found, this is Morgan Stanley, put out by Bloomberg. This is what do they think the dollar's going to do, or the dollar index. After really going up high in 2022 in the fall, it's really been coming down. Going forward from here, if we have a hard landing in the economy, that means interest rates are going to be up pretty high compared to economic activity, and that could give some support to the dollar going back up. If we're in between that, where we still have high rates, but it's not a hard landing per se, they see the value of the dollar going down, and if we have a soft landing, they see the dollar showing even continued weakness. The correlation between the VIX and the S&P, it continues to decline. It's coming down. If you look at some of these red lines where I tried to match up spikes before and then what the market did after that, sometimes it went up, sometimes it went down. After this spike that we're working off right now, the market has been going up, so we're just going with the scenario that it's giving support to the S&P. The Ulster Index continues to show that we are pretty complacent. The VIX is still pretty low as well, and I'll show you in just a moment. We have sentiment getting possibly into the too far positive category. We have fear really at low points right now, and sometimes that can make the market vulnerable. Here's the equity put call ratio. With the up day, we saw the equity put call ratio decline on the daily chart. It's still declining on our 5-period chart. And here's a longer term look at that same chart. Again, when we spike, that often marks support for the S&P. Here's the VIX showing that it just continues to decline. We're not only under 20, we're down into the 18 range, both on a closing basis, and the bar chart is also showing a decline, and it was even a lot lower. It was that late day sell-off that kind of pushed the VIX back up. Here's the consumer sentiment reading, the final version of that. It came in at 64.9. That's the blue line here. So people are feeling a little bit better about things, but we still have interest rates that are very high. When we look at the bottom, the spread, even though it's coming down, is still quite wide when you look at the 2-year yield versus how people are feeling. And again, as I point out, these like to go in the same general direction in a healthy environment. And even though they're on different scales, they usually don't get so far apart from each other, but that's what's happening now. Our trend shows the ADX getting a little bit stronger, but still well under 20 with the green line on top. So we default positive, but we don't really call this a trend because the ADX is giving such a low reading. Here's the first daily chart showing how we got above this resistance level, and then we came almost all the way up to 4,100. And I just put that on the chart. That's a red line here. We'll see. Are we going to bump into that and go down? That also would match the December highs. If we could break out from there and then close at that level, this uptrend would look a lot more healthy. If we start to fall, I don't know if this black line that we just crossed over, I don't know if you could really count that as support, but we might come down to this pivot level. If we continue to drop, there's another pivot level here. There's the 250 period moving averages. There's the downward sloping trend line. We're starting to build a case for support if we do come back down. Now, if we do start to go down and we break some of these levels, that would turn things even more negative. Down on the bottom, you see where volume was above average. Here's the 2-year look at the daily chart. Not really seeing anything different. The reason I brought this chart up is this just shows some of the other resistance areas marking lows, which had been support, but then when we broke through them, they became resistance on the way back up. The Arun continues to go up higher, shows that buyers are in control, sellers are on the wane right now. So the comparison between the two is the oscillator on the bottom, and it looks like it could be getting a little toppy. It can go higher than this. There's other times when we had this particular reading and it marked a short-term to intermediate-term top in the market. Stochastics, the short-term, starting to roll over a little bit. This is a little bit of the weakness that we're starting to see, but they're still extreme positive. Seeing a little bit of a rollover in the intermediate short-term stochastic, but still extreme positive. The longer-term one is still showing improvement and starting to become extreme positive. Stoch RSI, extreme positive, as is the Williams percent R, and you notice we're coming down slightly. Here's the PMO study showing a little bit of weakness here. The PMOs that are rising actually declined a little bit. The PMOs that are giving buy signals, not really breaking out as the S&P's been going up. That's a little bit of a negative divergence. And the PMOs that are above zero, starting to get close to being extreme positive, but this really didn't shoot up the way price did. So that's another little negative divergence to be aware of. The rate of change going back 20 periods starting to look a little extreme. We could go higher than this, but we're just into that territory now. Here's the anchored moving average going back to the all-time high where we came right up to that level and have been coming back down. The bullish percent index continues to be hanging in there, but it's not breaking out as price has been going higher. It's not giving us an extreme reading. So it is positive, but it's not going up as fast as price has been going up. Here's another one where a lot of folks, they don't use the bullish percent index of the S&P 500. That's what I rely on most. They rely on the NYSE because that gives a broader measure of the market. So I wanted to include that chart here where we're starting to come back and retest this high going back to August. If we could break out above that, that would suggest more strength for the market and things are turning more positive. If we turn down from here and start to go down, that could be a failed test of resistance. Chaikin money flow still looking pretty strong right now and could go higher than where we've been. The Sean trend meter also starting to look extreme positive. The CCI 14 is looking extreme, as is the 20. Chaikin oscillator also starting to get extreme. Could go higher than this, and it has before, but other times this can mark some form of exhaustion, if not an absolute top. The ultimate oscillator, don't show this one very often. We don't get a lot of signals here. We're starting to get extreme positive with this oscillator. Short-term fib levels, not really showing anything significant currently. We're in no man's land on the short-term fib chart, and we're entering into no man's land with the longer-term fib chart. The Swindlin trading oscillator based on price ticked down a little bit. That's kind of interesting. It picked up that late day weakness and the fact that on this bar, if you can see that, we closed more in the middle area of the bar. Based on price, we are still continuing to advance. Moving average tree, we're above all the moving averages now, and the longer we can stay up here, the better these moving averages will look, and they'll start to turn up and support more of an uptrend if that's what happens. If we look at this chart and we look back in June when the market was really going up, the moving averages were trying to improve, but then we hit the 200-day moving average, came down, and we started this roller coaster look for all the moving averages. Elder Impulse still positive. We're starting to get up here to this 4100 level. The McClellan oscillator, it's still positive, but it ticked down slightly. It also picked up some of that late day weakness, but it's still positive overall. The summation index based on price and volume continue to advance. New highs, new lows, also suggesting some weakness internally. As the S&P was going up, we didn't really see a breakout of new highs. In fact, our 5 period is rolling over. It's kind of, it might be a little bit positive there, but it's not as strong as what you would like to see. And then our 10 period moving average differential, that's just going up very slightly. Advanced decline line, though, it's looking positive now. We're above the moving average based on price and volume. If we can stay above this based on volume and get this moving average to turn back up, that would be even more positive. Accumulation distribution, above an advancing moving average. So this is more positive. The Copic curve, we're still working off of a buy signal for this. This could roll over and go away pretty soon. This doesn't necessarily mean that it would be a top if we do see that. And the same thing is true with the Pring bottom fisher. We're actually starting to cross over now. This just means that this was a signal that the market's going to go up, and now that signal's going away. There are times when this rolled over, when we saw some kind of a short-term top, but there's other times when this rolled over and the market just kept going up. So we mainly use this for trying to pick out when the S&P 500 has bottomed and is then starting to go up, hence the name Pring bottom fisher. Moving average study in the longer term, our 150 is still looking pretty extreme, and the 200 is advancing and not necessarily extreme yet. The diamonds are still positive overall. Can we break out above this 34.2 level? And the NASDAQ. This was a warning sign that I thought the markets might run into. The one thing that you'll notice about my analysis of the markets is I like to come up with a lot of lists of negatives when we're going up and positives when we're going down. And then if those things don't come to fruition, fine. But at least we're not caught off guard. This is a process that I had to go through in my own maturation process of analyzing the markets. Is what threw me for a loop the most was getting caught off guard. And so I try to plan for every possible contingency. That's why my approach to technical analysis is a lot different than other folks, in that I want to look at everything I can. Is it telling me something positive, negative, or nothing? And then take all of that together and then reach a consensus. Well, that's what I did after Thursday's session. We saw two indexes, the NASDAQ and the NASDAQ 100, bumping right up into their 200-day moving average, an average that it had not been at in all of 2022. Now we were able to break above that. So that's positive. Can we stay above that with the NASDAQ and the NASDAQ 100? The Qs for the Elder Impulse system are still positive and could be showing a breakout here. The home builders had a pretty good day on Friday, where we're seeing the S&P starting to break out, making higher highs and higher lows, where here we're finally starting to make a little bit of a higher high with this ETF. Now, this is very short term. Down below, when you look at the ratio, it's still underperforming a bit, but it's a little bit improved. And because the home builders are not really keeping up with the S&P, we're seeing this relationship start to falter a bit. Looking at a few charts for our possible positive scenarios, the Qs to the S&P showing some strength. Discretionary really had a good week. It's been starting to perform well. And large cap growth against large cap value is also showing some improvement. Looking at some of our growth value ratios for large caps, this is the same chart that I just showed you, showing some improvement. A little bit better for the mid caps and not doing as good for the small caps. In a good, healthy environment, we want to see both the small and mid caps really perform well, if not even outperform the S&P, because that can give some support to the S&P. Our staples still looking pretty good. We had a spike up here, and we've been really coming down fiercely. And this gives support pretty much every time to the S&P 500. So that could be a lot of the reason why the S&P has been going up. But we need to see more of a breakout here on the price charts. Our outlook for Monday, the technicals are positive. They're above this long-term resistance. Again, the further we get away from that, the more days that pass by, we could possibly turn that into support if we start to fall from here. But we are becoming short-term and intermediate-term overbought. We don't have any economic reports coming out on Monday. The whole list of geopolitical events, keeping an eye on the Russia-Ukraine situation. The markets are really fixated and continue to be so on inflation and interest rates, which are producing growth concerns, as well as the EPS and valuation concerns. And then earnings will be coming out in the upcoming week. And then we'll have to see if anything gets handled with the debt ceiling. Looking at the statistics for January 30th, not all that great. We're neutral to negative with the Dow. We're a little bit over 50%, so we're neutral to positive with the S&P. The NASDAQ is a little bit under, so it's at 47.6 or neutral to negative. What I'll be doing is, at the beginning of February, I'll probably revamp this whole slide to go with the statistics for February. But we're waiting to see what will happen at the end of January. If we end up positive, which it looks like we will, the January barometer is going to be positive, and that would give us a 3-0 score for our trifecta. And the market's been very positive going forward when we have that kind of a score. And I'll have the statistics and some charts to show you when we get to February. Our scenarios can't really go with the down one because our technicals are positive. We're above that trend line, but we are becoming overbought in the short term and intermediate term. It's really hard to go with the positive one because we're not trending right now, but our technicals are positive. We may be breaking out. If we get above 4,100 and then close above that level, that would be more signs of a breakout, and you'll see a lot more people turn positive. It might even help our ADX and try to pick up a trend if we can continue to go up. But we are short-term and slightly intermediate-term overbought. Our scenarios, they're doing okay. The rotation's showing some improvement, and our setups, we're not really working off of those now because we didn't have extreme negative readings as we were coming into this phase. So we're going with the sideways trend. The ADX, it is above the moving average, but it's still below 20. The green line's on top, so it is positive. Conclusion, the S&P is positive, above the trend line, but becoming more overbought in the short and intermediate term. Short-term, positive overbought. Intermediate-term, positive, becoming overbought. Long term, we're turning more positive because we're above the 200-day simple moving average. Thank you. I'm also going to include some like and subscribe stuff on the video. Let me know if you find that obnoxious. So on that note, have a great weekend, and I'll prepare the weekly video, the intermarket analysis video, and the deep dive video, and have those posted over the weekend.